Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be going over how do you take just investments of $5 a day and turn it into $1,128,352.97. How do you take just $5 a day, something as simple as the price of an average cup of coffee on your way to work, or maybe just cutting back on shopping? How do you take $5 a day and take it to such a large number for retirement? So we're going to be going over that. We're also going to be looking at some things this episode, including the average return for the S&P 500. We're going to be looking at the dividend yield for my M1 Finance portfolio. We're also going to be looking at some of your guys' channel comments, and more importantly, we're going to be showing you guys the spreadsheets that I'm currently tracking using my M1 Finance portfolio. So as usual, to start, we're going to start off with showing you the update of my portfolio. And as always, if you guys enjoy watching my videos, if you're interested in using M1 Finance, use this link right here. The link is in the description of all of my videos, and you can copy it right here. You can put it into your web browser, and you can use my portfolio as well if you're currently interested in investing in that. That link is also in the description. And if you sign up, you get $10, and I get $10 as well. And I'll mention you in the video if you use my referral link, and I'll be adding that $10 to my portfolio to increase my dividend income. So let's get an update on my portfolio. We are currently $1,708. And let's look at some of the biggest gainers and some of the biggest losers in my portfolio. So right now, the biggest gainer in my portfolio is Apple. Apple has shot up the last 2 or 3 days, and it's moved significantly higher, and some of the top dogs like Discover Financial has moved down. The biggest loser in the portfolio is Caterpillar. Caterpillar and Wells Fargo are the only two stocks that I'm down on. I just entered in the red today with Wells Fargo. The 3 banking stocks that I own, Visa is a fintech, but the financial stocks that I own are all doing poorly this week. They're doing significantly worse than the market. The banking sector is very much lagging. So I'll be lowering cost basis on these stocks as well as adding more to my positions. So on my activity screen here, you can see that I moved another $100 over. We did our second deposit, and we did 23 buys in the portfolio. We spent $1.86 on Johnson & Johnson, $4.27 on McDonald's, $2.63 on AT&T, $2.93 on Verizon, $1.47 on Altria, $7.76 on Broadcom, $7.59 on Southern Company, $1.22 on Foot Locker, $3.59 PepsiCo, Cisco $1, Coca-Cola $3.33, 3M $4.85, IBM $4.25, Wells Fargo $9.48, Caterpillar $8.33, Visa $8.77, Realty Income $3.67, Kimberly-Clark $3.95, Microsoft $1.44, Waste Management $3.81, Discover Financial Services $3.19, JP Morgan Chase $3.59, and Procter & Gamble Company for $4.05. So that comes up to a grand total of $97.09 out of the $100 that I deposited was invested. So that leaves $2.93 in cash left that we'll invest the next go around. So in total, my portfolio is up 7.5% exactly, which is $113.50, and we have earned $1.99 in dividends. Today, we are down 1.45%, or about $25.15. We did earn a dividend today for 62 cents, and the dividend that we received that claimed their dividend today was Foot Locker. We'll receive that in a couple weeks, and we got that for 62 cents. So as you see here, we're going to take a look at the spreadsheet that I came up with for this portfolio. The spreadsheet here is going to track our annual dividend income, our monthly dividend income, and our portfolio value. So this is not the current numbers. These first columns are the 66, 67, the 1500, and the 0 are all the real numbers, these 3 right here. I went ahead and plugged in next month numbers using today's numbers, such as the $1.99 in the current portfolio value. It was $17.20 when I was preparing this video. It's went down a little bit in the last couple minutes. So what I'm showing here is the 30 stocks I have on this list, from Broadcom all the way down to Verizon. If you add up the number of shares I have and multiply that by the paid dividends that they pay annually, that means with the $1,500 that I spent on April 3rd, it will make me $66.67 a year just in dividends. That's before dividend raises. That's before any other kind of dividend reinvestments, new deposits. And this is what we have now as of today. This is what has increased since we started the portfolio. So if you see here, if we go down the list, we have increased our dividend income on nearly all of these investments. I showed you guys that Johnson & Johnson raised their dividend. The day after, Procter & Gamble did so as well. Both of these stocks have raised their dividend. So I already have 2 of my 30 stocks that have raised their dividend in just 2 weeks out of the 30 that I own. So that's pretty cool. Seeing the 23 stocks that I buy right now. So that will increase my annual dividend income by $4.21 since I started this portfolio. So now, even though we will be making more purchases before the month end, as of today, from $66.67, we now have $70.88 in annual dividend income. Obviously, that number will continually go up as more of these companies raise their dividends, as they make more deposits, but as of now, it's $70.88. The portfolio value has went up, and our monthly dividend income will continually go up as well. So I'm going to be using these portfolio spreadsheets to track my dividend income and stuff like that, and we're going to be including these in the video from now on when I have to update these. So I hope you guys like what I made here, and comment down below what you think about them. And speaking of comments, I wanted to mention that I really appreciate all the love and support that you guys are giving me down in the comment section. These are some of the comments that I highlighted right here. Please continue with these comments. I love the support, and I love when you guys comment down below. So make sure to comment down below a video idea for the next video. So how do we get $5 a day up to $1,128,352.97? So what we're going to do, I'm on investor.gov. We're going to reset this calculator. The initial investment is going to start with 0. We're going to start with 0. This is not some hypothetical, unrealistic scenario where you have an inheritance or a rich family, or you come from a very high-paying job and you start with $10,000 or $100,000. This is starting from scratch. This is if you have $0, like my portfolio just was a few weeks. You guys are going to watch me grow this from scratch, and I'm giving you a perfect example how just 2 weeks of having your portfolio can already start to increase your income. It's not a large amount, but it's a start. You don't get rich overnight. It happens on a long-term basis. So we're going to start with $0, and the monthly contribution is going to be $150 a month. Now, the reason we're going to pick $150 a month is because that is $5 a day, and $5 a day is doable for almost anybody on any income. So when you think about people that show their portfolios and they're in the tens or even hundreds of thousands, a lot of times they have very high-paying jobs, or they have very unrealistic standards, such as, like I said, rich families, etc. But $150 is doable for just about anyone. The most common example that I see is people talking about going to Starbucks every morning. If you go and buy a Starbucks coffee every single morning, that's more than likely right around $5. If you were to take that $5 and invest it rather than spend it on coffee, you could have $150 set back every single month, but that's not $150 saved. That's $150 invested, which is 10 times more powerful than that money saved will ever be. And we'll be showing you why. This is why we'll be showing linear versus exponential growth, and we'll be showing that in a minute. So the example for the length of time in years that we're going to be using is 47. 47 years. Now, I know that is a very long time. Why we're going to use that? Because that is the example of an 18-year-old hypothetically retiring at age 65. Now, a lot of you watching this are not going to be exactly 18 years old. I know, looking at the demographics from my channel, a lot of people that watch are typically right around in their 20s. I'm currently 21, so it'd be 3 years less for me than this. But you can move your mouse along with me as we go through the portfolio, and you can base the amount of years if you're older than 18. 18 years old is when you can open a brokerage account with any kind of parental supervision or permission. So 18 years old is a lot of times when people are graduating high school, they're getting jobs. If they're going to college, maybe they're working through college, they're opening up their first 401k. 18 years old is a perfect example, and it'll show you the difference it'll make over time. So the estimated interest rate. So what we're going to do, we're going to Google the S&P 500 average return. What is the average return of the S&P 500? So those of you who don't know, the S&P 500 is the top 500 most valuable companies. So the average return is 9.8%. That is the average over the last 100 years or so. 9.8% means if you put $100 into the stock market, into the S&P 500, you will make $9.80 a year on average. Now, some years you will lose $20 out of that 100. You might make $50 out of that 100. It is all about timing, it is luck, and it is more importantly focusing on the long term, because who knows what will happen in the matter of 6 months to a year. If you look here, what we're going to do is search the S&P 500. So we're going to go to SPY, which is the ETF or exchange traded fund, which tracks the S&P 500. If you look at the 1-year chart, this doesn't look very promising. You would have lost money if you had invested 1 year ago. This is not something that a lot of people think about when they're thinking about growth investing versus dividend investing. Because if you would have invested a year ago, you would be down on your money. So people will see this number, they'll see the red, and they'll say, why are you investing? What is the point of investing if you're just going to lose money? But if you look at the 5-year chart, things look a lot better. The longer this chart goes, the more of an uptrend we will see. And this is where we're going to be talking about exponential growth, as well as the dividends compounded along with that. No one knows where the stock market is going to go tomorrow or in 6 months from now. One of the most rich and important and intelligent investors in the world is Warren Buffett. He's came out and said many times he has no idea where the market is going to go tomorrow. No one can predict it. 9.8% is the average, so in our calculator here, we're not going to use 9.8, we're going to use 9. The reason I'm going to use 9 is because we're going to be conservative. Over the course of 40 plus years, that number could be much higher. It could be all the way up as 15. It could also, we could go into a massive depression, and who knows, it could be as low as 6. So what we're going to use is we're going to use a little bit below the average. We're going to give a conservative standpoint. So 9%, the estimated interest rate, and the interest rate range, we're going to start with 0, and I'll show a different example in a minute. That's compounded annually, so every single year. And as you can see here, in 47 years, you will have $1,128,352. So this is linear versus exponential growth. This is what people talk about when they say compound interest and how investing for the long term can seriously make a difference once you start getting on a time base. Time in the market will always be timing the market. So as you can see here, we have a blue line and a red line. The blue line every single month will go up $1,800. $1,800 like clockwork. Now, let's go back to year 1. On the red line, it will go up significantly more than $1,800 the further you go on the line. So this is going on a steady straight line. It doesn't change for the blue line, but on the red line, it is continually going on more of an upward angle. It just slowly starts trending more and more into the upside. And if you go all the way to the last year, you're making a lot more than $1,800. The last year, you're making about 90, almost 100,000 on the last year, and that's making only $5 a day in investments. So every year you invested, your wealth is going to increase exponentially, or each year you're going to make more than you did the last. So as you can see here, let's use these last 2 years for example. As you can see here, 946,000 to 1,033,000. So we went up about 87,000-ish, about $87,000. But the next year we didn't make $87,000. The next year we made nearly 100. I believe that's 95,000. So we went from 87,000 to now we're making 95,000. If we were to keep on going through this graph, the next year we wouldn't make 95,000. The next year we'd make probably about 105,000. The next year would be 118, and the next year would be 120 something. It would continually grow every single year. So what we're also going to look at, we're going to look at some interest rate variance range. So this means showing the difference versus a good versus bad scenario. So what we're going to do, we're going to show the difference between a 7%, a 9%, and an 11% return. The interest rate that you receive off of investing your money will always far outweigh the monthly contribution. So a 9% return is a pretty steady, stable return. Hypothetically speaking, if you were to get a 12% return or 15% return, that's a little bit unrealistic, but if you were to do that, it would be astronomically higher. 1.1 million would be a joke. Just out of curiosity, let's just plug in 15. So instead of 1.1 million, you would have 8.5 million. So 6-7 times higher than what it would be if you just had a 9% return. So let's go back to 9% return, and let's use a 2% interest rate variance range. So that'll show a 2% difference on the best and worst case scenario. So this is a 7%, 9%, and 11%. On the 7%, you would have about 600,000. On the 9%, as we showed before, about 1.1 million. And on the 11%, about 2.2 million. So nearly doubled on just a 2% increase. So this is why I want to show dividend growth investing. In the long run, dividend growth investing has showed that it will outperform the market in the long run. The reason is, in bull markets, you will underperform the market, but in bear markets, you will outperform the market. Here's the reason why. You mostly have 2 categories for stocks. You have growth stocks and you have dividend stocks. So let's show you a growth stock. One of the only growth stocks in my portfolio, for example, is Microsoft. If we go to Microsoft and we look at the last 5 years for Microsoft, in 5 years, the stock has went up 307%. Now, that is massive growth. Huge growth for Microsoft. If you would have bought this 5 years ago, you would be very happy with your returns. Now, here's the good news about that, and here's the bad news about that. First off, buying the stock 5 years ago, would you have the discipline to hold it? When the stock got to 115, how would you have known that that was going to be the peak? How would you have known that it was going to drop to under $100? Would you have had it at 115 and then sold it at 100? Would you have panicked? Or better yet, if you were to hold it through that, when it broke past 115, when it got back to 116, 117, 120 right here, would you say, oh my gosh, it just broke out to new highs, it's going to drop again, I'm going to sell it? Well, if you would have sold it there, you would have missed out on a lot of gains. On the flip side, if you would have waited until it got right here and you said, oh my gosh, it's at $183. It's never going to stop. It's going to keep going no matter what. And you're thinking, oh my gosh, I'm going to sell it once it gets to 200. Well, then it goes from 180 and then it drops all the way to 130. Would you have sold at 130 and missed out on a huge portion of your gains? This is why growth investing is not what I'm looking for, because trying to time stocks is like trying to time the market. That's why I say time in the market beats timing the market. So if we go to the last year, what if your entry point for this stock, what if you thought it was going to 200 and you bought it at 180? Well, now you'd be down on your position. You'd be down on a growth position, and the thing is, regardless of how much you are up or down on a growth stock, the only way you make money is if you sell that position for more than what you bought it for. So if you buy the stock for $180 a share, and at any point you sell it and it's less than $180, you lost money. If you hold the stock for 5 years and you sell it for $180, your share price gains are zero. Your money is literally losing value every day it's not going up. So for dividends, it pretty much stays the same. If you look at a very old dividend aristocrat, a company that's been around for a million years, is Coca-Cola. For example, let's look at the last 5 years on them. Their performance is very low. It's only 17%. That's not huge share price gains. I get it. But their dividend income is safe, steady growth continually for 50 plus years now. They started with 33 cents, and now they're up to 35, and then they go to 37, and then they go to 39, and then as of the last quarter, they shot it up to 41 cents. They just raised it again. So just like a month ago, a little over a month ago, they raised it again. That's going to continue to happen as long as people drink Coke and use their beverage products. So even in the last year, we're still up a little bit, but regardless, as I mentioned in my previous video, I talked about dividend yields. If this stock goes down in price, right now it yields 3.45%. Where I bought it at, it was yielding closer to 4%. So at $41, if you're buying the stock here, if you're buying the stock at $37, you're getting over 4%. You're getting like 4.3, 4.4 rather than 3.4. So you're making more in dividend yields. So in a weird sort of twisted way, you almost want your stocks to go down. The reason why I talk about every single day, we update you guys on my portfolio, the reason why I say do not be so focused on this number. Be focused on this number. Celebrate this. It's cool to see market gain. It's cool to see your stocks go up. That's great. I'm not going to hide away from it. Of course, I'll be factoring in market gain. Eventually, my stocks will go up. It may take a day. It may take a decade. But eventually, this number is going to significantly outweigh any market gain. It will take a while, but this is the number that you need to look at, the earned dividends number. With the growth stocks, there's no telling when they're going to run out of fuel and when they're going to stop growing. They could keep going or they could stop tomorrow, and you will have no idea whether or not you'll be getting money. Nvidia is a perfect example of this. So Nvidia had a huge run-up. They've went up over 1,000% in the last year. If you would have had this stock, and you would have owned it at $270 something, $286, $290. What happens when the stock drops all the way to 130? Do you sell it? Well, why would you not? The stock just literally cut everything you had in half, over half. What is your incentive to own it? When the stock peaked, it was in 2018, in October of 2018, and it didn't get even close back to its highs until February of 2020. So it was about a year and a half until the stock even got back to where it was to where you could break even. So for a year and a half, you have zero gains. You were just waiting to get back to the highs so you can get back to where you were when you were sitting nice and pretty when the stock was almost $300. So going back to the compound interest calculator, so whether you're focusing on index funds or whether you're focusing on dividends, It's better to focus on the long term and focus on compound interest rather than trying to make the quick buck. Trying to find your Netflixes that are going to go up 10,000% in the next 10 years, because there's a 90% chance you're never going to find it. And even if you do find it, you're not going to have the discipline to stay inside the stock. So one cool thing about M1 Finance that we're going to show here, we're going to go to the research tab. And then we're going to go to funds. There's stocks and there's funds. We're going to click funds. So there's a couple different things you can look at. It shows the most popular funds here. Like I said, the SPY, the Spider ETF, S&P 500. So you can filter by a couple different things. You can filter by total assets, by dividend yield, by expense ratio. So let's take out dividend yield, and let's put the minimum dividend yield at 4%, and let's put the max at, say, 6%. The expense ratio. So what the expense ratio is basically essentially the fees for it being managed. So let's put the minimum at 0, and let's put the max at 0.5%. So if an index fund has an expense ratio of 0.5%, that means 0.5% is taken out of it every single year. So as I showed here with the 2% difference, a 2% difference over doubles your performance in the matter of 47 years. So you do need to look at expense ratio and see how that affects your portfolio. So as you can see here, 123 results pull up. So let's get a little bit more finite. So let's get the expense ratio down. Let's get it all the way down to 0.1%. So only 8 show up here. So these are all the index funds that are highly focused on dividends that are very high yield and they don't have a very high expense ratio. So these are some examples of some index funds that have very low expense ratios. So these are all 0.8. One of them is even 0.0. And they will take very little from your returns. So one that I see people use all the time for dividend investing is SPHD. There's a couple reasons why people like SPHD. The expense ratio isn't out of hand. 0.3% is it's enough to factor in, but it's not enough that it's going to take out completely your gains. And one thing about SPHD is it pays out dividends monthly. Now most stocks pay out dividends quarterly. SPHD is not one of them. So as you can see here, it usually floats around 9, 10, 11, 12 cents, and it's been steadily going up. Now we're in the 14s and 15s. So now if you get to today, we're around 15, 16 cents every single month. And some of its top holdings are Iron Mountain Incorporated and AT&T. AT&T is a stock that I own that is very high yielding and a very large cap company. All their money is in stock, very little in cash. So this is a stock that I see people a lot of times talk about if they're interested in ETFs, if they're interested in index funds. I personally do not like funds. I like investing in individual companies. There's a couple reasons why. You have control over your investments. So this management team at Invesco that manages this can decide at any moment if they say, okay, AT&T, we don't want it anymore, sell it. And it'll take it out of the portfolio and they'll replace it with something else. I have no control over that decision. The same thing with Iron Mountain and all the other holdings that they have. They have 51 companies in this portfolio, so more than mine. If they get rid of one of those 51 companies or add a new stock, I have zero say in that. They could be adding a horrible company that I hate. No control. They could have an amazing company that I love. No control. So once again, this is a stock that I wouldn't choose. I don't like index funds because that 0.3% also gets taken away as well as no control. If I want AT&T, I can just add it to the portfolio, which I already have it in my portfolio. So this is a perfect example why I personally like to do my own portfolio rather than rely on some Wall Street manager to do it for me. But if you want to do index fund investing, the S&P 500 or the SPY is probably the best place to start because it's so simple, it's so straightforward, and everybody gets it. It's the top 500 companies out there, and it does pay a dividend. Every single quarter, it pays a dividend that goes up steadily over time, and it has a dividend yield right now of about 2%. The expense ratio is very low, 0.09, so that's so minuscule, it's under 0.1%, so that's not going to make a very large difference on your returns. And as you can see here, it tracks the S&P 500. Basically, what you're betting on here is you're betting on America. If you think that America will go up in the long run, which it always will, there's a couple reasons why the stock market will go up in the long run 100% of the time. It's because of these factors. Dividend reinvestments, people who get their dividends, if you get $1.38 here, they put it right back into the stock and it makes it go higher. GDP growth. Every single year we produce more. Next we have inflation. Inflation goes up roughly 2% every year. So every year you're not getting 2% on your money, you're losing value. So that's about the dividend yield here. That'll match inflation, and then the share price gains will outperform that. Next is population growth. That'll mean more people that need to have jobs. That'll mean more people that need food, water, shelter, and they'll be spending money on products like the new Apple iPhone. So that is more money spent, so that's more money for the economy and more money invested. Another reason is share buybacks. That is something that is a little bit high debated. I mentioned that in a previous video when we were talking about Bernie Sanders getting dropped out of the presidential race. But share buybacks, stocks will buy back their own shares and it'll make their share price perform very, very well. So like Visa, for example, is one of my holdings. Like I said, I am a bit indifferent on share buybacks, but every single year they buy back huge amounts of stock. That's part of the reason the stock has went up 152% in the last 5 years. I own them strictly for the massive dividend growth. They went from 12 cents and now they're all the way up to 30 and they'll keep going up. But regardless, they will probably have very high share price gains just because of the share buybacks. So if you look at the SPY, they even have an SPYB, which is the S&P 500 share buyback index fund. So now, if you were to do this and you were to have your $5 a day over 47 years and you were to get 9% exactly, and you were to have 1,128,000. Let's put that into the calculator. So what we're going to do here, we're going to go 128,000, and what was it? $352. $352. Now, what is the amount of dividends that you can get on that? I'm just going to use my portfolio as a perfect example. So as of yesterday, this is updated every single day. When the market closes, it updates the dividend yield when you preview my portfolio. So if you were to buy my exact portfolio with the exact target percentages, Broadcom, Realty Income, and go all the way down and own all these 30 companies exactly as I do, you would get 4.074% dividend yield with a 0% expense ratio. So you would lose 0% using my portfolio. The link is in the description if you're interested. And we have 30 different companies. So we're diversified between 30 different companies, and the most at risk here is 8%. So if tomorrow Broadcom, which they're not anywhere near bankruptcy, but if tomorrow Broadcom said, okay guys, we're declaring bankruptcy, 92% of my portfolio is safe. This is why you want to diversify your portfolio and not put all your eggs in one basket. When I talked about dividend growth portfolios and how the share price gains are slow, but the dividend yields are massive, as you can see here, over the last 5 years, my portfolio has got 40.11% in share price gains. So that means I'm getting over 40% over the next 5 years based off the last 5 years. Who knows if that number will be higher or lower 5 years from now. But 40% in the last 5 years, not to mention this massive dividend growth. So that will highly outperform the S&P 500. When you look at SPY stock over the last 5 years, its stock over the last 5 years has only went up 32%. This stock portfolio has went up 40%. Not to mention the dividend yield is higher at 4% and the S&P is only 2.09. So let's take that 4.074% and multiply it times this number. So let's take that and multiply it times 0.04074. That's the current yield as of today. That means you would make almost $46,000 a year. That means with this portfolio, you would make $46,000 a year in dividends alone. That's just in dividends. That's what you could take out and put in your pocket without investing anything. Now, that number will do nothing but go up. Even if you don't deposit anything to this portfolio, this will still go up because stocks will raise their dividends every single year. If you were to put this on a monthly basis, let's divide that number by 12, and this means you'll get $3,830 a year. That is such a significantly high number and could probably cover a lot of people's bills. Almost $50,000 a year, day one. Not to mention it's going to go up every single year. Most people live well past 65, so this just shows you the power of investing as little as $5 a day. So my portfolio, which I'm not any kind of financial advisor, any specialist, I'm just the guy on YouTube that you watch, can already get 4% based off his portfolio, which are very safe, strong companies. So this is why investing $5 a day, you can become a millionaire. Make sure to comment down below what you guys would like to see from me from a video perspective, opinions on stocks, on anything of the sort. I would love to answer back to that. And as I mentioned before earlier in the video, don't forget to use this link if you're interested in using M1 Finance as your brokerage, because I would love to get $10 and you would like to get $10 as well so you could start using dividend investing strategies. And I would like to thank you guys so much for watching. If you made it to the end, make sure to smash the like button, hit the subscribe button, smash the notification bell, and I'll see you next time.